Hey, what's up, guys? Welcome to Accounting with Karim. As always, before we start, honesty and integrity builds credibility. For this video, we are looking at purchasing merchandise inventory and what does that look like? How do you account for merchandise inventory under the perpetual inventory system and also under the periodic inventory system? So let's have a look. Firstly, let's look at the perpetual inventory system, right? So purchasing merchandise inventory looks like this. We debit inventory account directly and we credit AP. So we make a purchase under the perpetual system, we debit in the inventory account and we credit AP. For the periodic inventory system now, we are not affecting the inventory account. We debit purchases and we credit AP. So remember, for the periodic system, right, we don't know how much we have in inventory until at the end of the accounting period because we have to do a physical inventory count at the end of the accounting period. This is how we find out the cost of goods sold, how much to allocate the cost of goods sold at the end of the accounting period, right? For the perpetual system now, we always have an approximate number of how much we have in physical inventory because every transaction that affects merchandise will also affect your inventory account. So you're making a purchase, you debit in your inventory account. You make a sale to a customer, you credit your inventory account and you debit cost of goods sold. So there is always an approximate number that you know that you have in physical inventory. What does that say? It say, hey, the perpetual system is more efficient. It allows for way better inventory management, right? So, right, let's look at the GL. We have three GLs, just for example, cash, inventory, and AP, right? So, below the GL, we have the subledgers. And so for cash, we don't have a subledger. We don't need a subledger for cash. We really don't because cash is yours. And so almost all transactions will affect cash, right? So you don't need a subledger for cash. Inventory, we need subledger because we have to keep track of individual inventory items. And so the GL just shows you the aggregate amount of what those individual subledger. Same goes for accounts payable. We have subledgers for accounts payable. We need to keep track of the different vendors that we have, right? Different vendors. How much do you owe vendor A or vendor B? And also different vendors will have different terms. One vendor might grant you a 30-day term. Another vendor might grant you a 15-day term, right? So you have to keep those, separately. Yeah, so let's look at the different components that we have to take into consideration when we make a purchase under the perpetual inventory system, right? So we're looking at sales taxes, right? We have GST here, we have PST, and so also we have HST. Depending on the province that you're in, this will be different, right? So one thing that I will say, first thing first, is that if you're a company that, buys and sells merchandise, usually you're not supposed to be paying PST, right? The final consumers are the ones who pay PST on the final purchase, not the merchandising company, right? But the main point here is to keep in mind that any taxes that is recoverable, it cannot be a part of the cost of your inventory, right? So GST is recoverable, right? So this cannot be included in the cost of your inventory. That's the first thing first. Down here to freight, right? So freight costs is we have two different costs to freight. And so we have FOB shipping point and FOB destination, right? So FOB shipping point, that means the buyer has responsibility of the cost of transit, right? And FOB destination, that means the seller has responsibility for the cost of transit, right? In transit goes to the seller. So the buyer doesn't take responsibility until he gets the goods, right? That's FOB destination. Here, let's say for this example, FOB shipping point, right? I'm the buyer. So this example goes like this. Say the freight cost is $150, right? So I have to debit inventory for $150, right? That goes to the inventory account debit because it's a part of the cost of my inventory, so it needs to be added to the inventory account with a debit. Well, the actual purchase for my inventory was $3,500, right? So it's a debit to the inventory account and a credit to AP. This is a journal entry. This is a T account. Let's say I receive my shipment and a couple items were damaged. So now I have to return. So purchase return is a credit to my inventory because now I'm sending this item back to the supplier. So two things. One, the inventory account will be affected. So I have to decrease my inventory account by that amount. Also, I don't owe the supplier anymore, so I need to decrease my accounts payable by that exact amount, right? Also, let's say the supplier say, "Hey, if you make a payment within 5 days of shipment, we give you a 2% discount." Let's say the 2% discount turns out to be $50. It is not, by the way, based on how much we pay here. Don't do the math on this one. We need to credit the inventory account, also debit AP, because now we don't have to pay this amount to the supplier, and also it's no longer a cost to the inventory, so we need to decrease the inventory account. All right, let's look at the sales to customer and all the components that we need to take into consideration. First thing that we need to look at is the sales taxes, right? So we have GST, PSD, and HST. Depending on what province you're in, this will look a little bit different, right? But the main point is any tax that you collect from your customers is a liability to you because ultimately you have to remit it to the government, right? So it's not yours, it's a liability. So for this example, the invoice amount was $4,000, right? $4,000, 5% of $4,000 is 200. So there's a GST payable here of $200, right? And so next thing we need to look at is the inventory account. Let's make the assumption that the cost of good, the cost of the inventory that we're selling to the customers is $3,500, right? So we need to reduce the inventory account by 3,500. Also, we need to add that same 3,500 to the cost of goods sold, right? So we need to debit cost of goods sold by 3,500. Let's look at freight costs. So again, we have FOB shipping point and FOB destination, right? So let's assume that this transaction is the agreement is FOB destination. So we, the seller, we have responsibility for the goods in transit, so we have to pay the cost of freight. So the cost of freight is $150, so we have to expense that amount. Let's look at sales return and allowance, right? So we ship the goods to the customer. They receive the goods. They say there are a couple items that did not meet the satisfaction. Nothing is wrong with the items. They just did not meet their specific satisfaction, right? So they ship it back to us. Nothing is wrong with the item, right? So we can actually resell it. So that will affect the inventory. So we need to add it back to the inventory account, the $100 here. We need to also reduce cost of goods sold because ultimately we did not sell the item, right? And also we need to credit AP because the $4,000 that we were initially expecting from the customer is no longer 4,000. It's now 3,900, right? So we credit AR for that amount and we debit sales to so the sales can actually reflect the 3,900 in the GL. The GST account will also be affected because now it's not 5% on the 40,000. It's now 5% on 3,900. And let's see what that looks like. Let's see what that looks like. 5% on 3,900. This should be 5. This should be 5. The sales return and allowance will also affect the GST, because now it's not 5% of 4,000 anymore. It's now 5% of 3,900, and so 5% of 3,900 is 195, right? So to get to 195 from 200, we have to debit the GST account by $5, right? Which will give you the 195. All right, so that's what it looks like for sales of merchandise to your customer. As always, before we finish, honesty and integrity build credibility. Until next time, I will see you guys. Cheers.